Mark, I just want to pick it up in terms of the impact that you and your team at TD think the regional banks will have on the economy and the outlook. What are you thinking there?
So I think a part of it is you want to use kind of a broader macroeconomic framework to think about this. Like you look through financial conditions. That's the way, again, I'm just kind of more focused on the implications for markets and currencies. But the way I kind of process this is, most conventional financial conditions models, which include credit, which include rates, which include the dollar, which include equities. You've basically seen with the stress in the US banking system, what could be the equivalent of 50 basis points worth of Fed tightening. And along with that, and along with the stresses that kind of come through maybe on loan origination or the credit from, one part of the sector being small banks and medium-sized banks to the larger ones, I think one clear thing is we'd likely to see more regulations and probably a slowdown in lending. So if the big banks don't want to pick up the lending that the small and medium-sized ones have done, you're going to have a contraction that comes through GDP. So on those conventional metrics of just kind of back of the envelope rule of thumbs, we've got equivalent of about 50 basis point worth of tightening coming through in financial conditions. And we probably will see something that's close to maybe a 1% GDP shock coming through in the US, which in our opinion, from our US macro strategists, is enough to tip the US into the hard landing category, which again kind of results in the Fed having to fine-tune monetary policy over the next couple of months, rate hike here or there, ultimately focusing on data dependence. But the big cutting cycle starts end of this year, moving into next year. So that's really the impact is you have desynchronization of US significant slowdown, but the rest of the world still kind of maintaining some acceleration in global growth momentum for a couple quarters.
Which I want to pick up on in just a moment, but you said a significant rate cut cycle. Is that right? Significant?
Yeah, we're looking for, I think, close to 300 basis points in cuts over the course of starting Q4. So 2024 is a significant reversal of Fed tightening.
That's a significant reversal versus obviously what they've been doing over the past couple of years to try to combat inflation. I mean, what does that mean in terms of your inflation outlook? And is it deflation or stagflation? I mean, if there's slower growth, where do you stand as it relates to stagflation?
So I think you could categorize it more as disinflation. So it's kind of, to me, the rate of change is kind of the key for inflation. I think there's a couple ways to think about the generalization of inflation across different countries is an important factor to consider. And then it's kind of like the broad generalization of inflation across different parts of the economy is another way to visualize it. So in terms of like global, what we do is we run different statistical models that tell us like how much global inflation is explained through one common factor. Last year, 90% of core inflation in G10 and emerging markets is explained by one thing, which tells you there was a global factor that drove inflation. That model is now kind of receded. We're about 60%. So what you're seeing is inflation is becoming more localized. And also, again, the big supply chain drivers that drove a lot of the supply side stress, which is also a big driver of inflation, has also eased. And China coming back online and China reopening, and again, you can see it through the PMI delivery times. All those things are kind of back to normal. So that is also going to be disinflationary. And then you add to the simple fact of the extreme rate of change of financial conditions and the adjustment that's come through in global monetary policy. That in itself is also disinflationary. So I think we're moving into a world where US growth is kind of doing what it would in a conventional tightening cycle, which is we saw where something broke. We saw the weaknesses, which is, again, part of the banking sector discussion we're having now. But this is generally what you would expect through that tightening of financial conditions. It's just we're never really seeing a synchronized global inflation cycle that led to aggressive monetary policy. And then we get to see China reopen from 3 years of being in lockdown, along with Europe basically navigating actually quite well through a colossal energy shock. So those two other components are quite important offsets to the US for at least this year, but I don't think we're in what you would categorize as stagflation anymore. That was really like last year's theme, I think.
Yeah. Okay. And good point in terms of, and good thing, I think, that it was perhaps stagflation is in the past. It's interesting as well, Mark, you talk about the desynchronization of the, various countries and policies and economies. I want to pick that up on the other side of the break, just in terms of how we should be thinking about that, specifically as it relates to how we invest. It's almost as though we don't want to just focus on North America anymore. Not that anyone necessarily did in the past, but that definitely was the winning trade for quite some time. But we'll take it up on the other side of the break. We'll be right back.